then make it as interactive as possible, posing any questions along the way. So with that, why don't we go ahead and get started. A lot of you were familiar with the Assured Solutions Gold product marketed under the name of United of Omaha, and now we've made a move into the MutualCare Solutions portfolio of products, bringing back in the name of Mutual of Omaha. Mutual decided to consolidate all of their long-term care offerings under the Mutual name. If you have been and have embraced the Assured Solutions Gold, the transition to the new product is going to be very easy for you. The look and feel is all still there. The strengths that you knew with the Gold product have been carried forward. In fact, we've made it stronger yet. So I just wanted to walk through a few key points as far as what we did when we helped the company develop this new product, and then I will break out into the actual software itself and show you basically some of the differences between the Assured Solutions Gold and the new MutualCare Custom Solutions product from Mutual of Omaha. So again, as we said all along, and I think Donnie may have already mentioned this to you as well, you couldn't have a better business partner in a company like Mutual of Omaha. Being a mutual company, all of their focus is inward on the policyholders as opposed to outward on shareholders. So they have the ability to do a lot of more long-term type planning as opposed to quarter-over-quarter reporting to Wall Street. So and rest assured that the fact that they are a strong, stable, and secure organization. They've actually published a brochure on that, and Don would be happy to get those to you as well as far as the financial viability being A and best of A+, and other very conservative portfolio investments for their own corporate investment portfolio as well. But we're pleased and proud to have them as a strong business partner. Yes, they have had rate increases on older policies as other carriers have. In fact, there's basically no one left who has not bumped rates on in-force business. But being a mutual company, those increases have been more on the modest side. If you haven't had a chance to look at the new paperwork with the Mutual of Omaha product, with every carrier, they have to disclose any and all rate increase history on the first page of the personal worksheet, going back to the beginning of time. And you'll notice that with the mutual companies like Mutual of Omaha, those rate increases have been fairly modest, averaging right about 15 to 20% over time, as opposed to some of the larger, more publicly traded companies that have had significantly higher rate increases. So you should feel comfortable and confident that working with Mutual, you've got a strong business partner in your back pocket. And just for FYI, we are not doing voice over IP with this webinar. You have to be on the conference call to be a part of the webinar. So just a heads up for everybody. What we have found over the last 5 years is there's been more of a trend, especially with the comparison type software. We even have it running on our website where you can do side-by-sides, is that people are spreadsheeting, and they're getting away from the value of the policy and focusing more on the actual bottom line dollar. Whereas obviously premium is important out there, we do believe that you have to look at the value that the policy brings to bear. And those of you who have been working with us on the Assured Solutions Gold saw the value of that policy with the hybrid cash component. That same value is going to carry forward with the new policy as well. Just food for thought. It's not always about price. It's about what the policy can do for your clients when they potentially have a claim. Again, as I mentioned earlier, they're the best. I mean, they're strong. Financially they're strong. Administratively they do a great job. They are very forward-thinking. Just recently hired a brand new director of underwriting who's very, very agent-focused. Came to Mutual from Transamerica. A lovely gentleman to have a conversation with. He's not afraid to have a conversation with you one-on-one about a particular case you're working on or life in general. We're going to try to arrange to have him on a webinar just to have a chance to meet and greet the underwriting staff at Mutual of Omaha. But a delightful breath of fresh air in Alan Gregar joining the staff at Mutual of Omaha. Again, they continue to be a product innovator. There's one of only two carriers out there that offer a hybrid type policy with a cash component. as you'll see with the new product, very, very creative in the inflation protection options, allowing you a new level of flexibility to dial in a premium that really makes sense for the clients you're working with. The new product is of a portfolio called the MutualCare Solutions portfolio of solutions. There are two different policies that are offered. There's the MutualCare Secure solution and the MutualCare Custom solution. And there's a reason why we have a bigger picture of the custom versus the secure. We think for the most part that you folks over there in Hawaii will want to be focusing on the custom. It has a lot more flexibility in the plan design, as you'll see when I get to the software. A little bit richer on the cash benefit. It'll be pretty self-evident when we get to that point. The secure is more of your traditional type of a build of a policy where you select a benefit multiplier, say you have 2, 3, 4, or 5 years. Eliminations periods anywhere from 90 days to 1 year. Whereas the custom is more of a pool of money concept, where you elect a pool of money of anywhere from a minimum of $50,000 to a maximum of $500,000. It does open up lower elimination periods from 60 down to a 0-day. The cash benefit, as I mentioned, is a little bit richer on the custom. Joint waiver of premium, survivorship are available on the custom, not on the secure. So the secure is more of a product that is built for someone who doesn't touch long-term care very often, maybe once or twice a year, looking for a very simple solution, doesn't want to get involved in thinking about various optional benefits that may benefit their client to a higher degree. So that's and limited as far as what they have for offerings. Whereas with the custom, you can really get very creative, especially when you get to inflation. Anywhere from 1% to 5% compound inflation is available in 1/4 point increments. And then depending upon the age of the client you're working with, you can cap that growth at 10, 15, or 20 years on the custom, whereas you're limited to a couple of options on a 20-year cap with the secure product. And again, a lot of this will become more evident as we get into the actual software itself. Obviously, you have embraced us in the past with the Assured Solutions Gold product with the flexibility that that cash component of the policy can bring to your client at claim time as far as having complete control and flexibility to do whatever they want. It's always relevant. It's never obsolete. That same kind of a thinking is brought forward with the new product with Mutual of Omaha as well. Again, with a 0-day elimination period with the cash benefit, complete and total freedom to do whatever they want to do, whether it be to get around policy exclusions, such as paying a family member or a friend, excuse me, to take care of them, or perhaps some new form of long-term care services will show up 10, 15 years from now that we can't even fathom what that might be. And if it's not covered in the black and white in the contract, you really can't rely on the alternate plan of care language to cover that. So, but rest assured, the cash benefit will go a long way to help pay for any type of new services that come down the road. There's been kind of an evolution of policies over a period of time. Back in the early 80s, the policies would cover nursing home only. And then came along some standalone home health care policies. And then they kind of linked the nursing home with the home care rider, and then all of a sudden assisted living showed up on the scene. So policies have benefits, services have evolved over time, whereas perhaps contracts have not. So to have a long-term care contract in place that allows the policy to evolve over time, we think is key. So the odds of a cash component type policy developing any kind of obsolescence is minimized because of the fact that you do have that cash benefit, and cash will pay for basically anything that the policyholder wishes to pay for.
This is a hybrid policy. Okay, so it has a cash benefit. Usually it's either cash, get cash only, or you get reimbursed.
Yeah, the way the cash benefit works with the Mutual of Omaha, just like it did with the Assured Solutions Gold product, it's an either-or situation. The policyholder controls that on a month-by-month basis. So they either request a check from the carrier, or they accrue bills and submit bills to get reimbursed. They cannot do both functions in the same month, but again, the policyholder controls that month by month. We kind of draw attention to this benefit. Most all long-term care contracts specifically have in black and white in the contract that they will cover medical alert systems. Well, this goes back 15 years from now, and medical alert systems have evolved significantly over time. In fact, to the point where a lot of them are obsolete. If you notice down here, here's an actual phone jack. How many of the now generation would even know what a phone jack is? I mean, they're all completely wireless. There's a whole new concept that's building out from the East Coast called granny pods, where you can actually rent, basically it's a portable home housing unit, and drop it in your backyard. It's a self-contained 3 to 4 room type building that has a kitchen, living room, bathroom, and then a bedroom where mom or dad could be out there safely because there are floor sensors to sense a fall, cameras, medical alert systems, first aid kits, evolving into direct links to a doctor's office to eventually pick up things like electronic pillboxes that will notify someone that if someone hasn't taken their meds. All these things are evolving faster. They're not. And for the most part, these types of facilities are not covered in the black and white of a contract, whereas you can take the cash benefit of a policy like the Mutual of Omaha Custom Solutions product and use those monies to help offset the cost to help keep someone where they'd like to be longer, which is closer to home. For example, here's a few examples of technology that's available today that's not covered for the most part in the black and white of a contract for most long-term care policies out there. Monitoring equipment like cameras and video, wearable smart devices. I mean, there's one technology that's fast that is growing quickly. It looks like the new Apple Watch, but it actually is a device that monitors Parkinson's patients to see whether or not they're having a really good day or a really bad day, and they might need some assistance to be sent out there to watch them. Motion sensors, like I said, floor sensors to sense a fall. All these things, electronic pillboxes, all these things are coming along a lot sooner than later because obviously have you seen with the technology of smartphones and tablets and even PCs, it's like every 6 months the technology just goes up by an exponential function. So we're seeing a lot of that work being put toward the ability to take care of mom and dad a little bit longer to keep them where they want to be, which is in the comfort of their own home. Also, what we have seen in the last 10 years is the amount of premium that the companies charge to add inflation protection to a policy. Now, here's just one example of showing the load for a 5% compound rider on a simple built policy, $4,500 per month, with about a 3-year benefit period. You'll notice that for on a 45-year-old, out of the total premium of $570, $460 of that is the load just to cover the 5% compound inflation. That percentage goes down a little bit as you get older, but it is a significant part of the premium that companies charge specifically for the 5% compound. So even when the Assured Solutions Gold product rolled out, we were basically positioning that 3% compound is the new 5. Just because the 3% compound inflation rider is half the cost of the 5% compound rider itself. And we've taken it one step further with the MutualCare Custom, where we've allowed you now to go down all the way down to 1%. And you can go down and up within those ranges in 1/4 point increments. And a 1/4 point could end up equating out to about a $300 per year premium savings or a premium add to a policy. That can make or break your sale. That $300 could be that important. So the flexibility of being able to dial in a premium that kind of makes sense for your client. We're trying to give you that flexibility with the new Mutual of Omaha offering. And again, just to summarize the flexibility, anywhere from 1 to 5% compound in 1/4 point increments, and then you can cap that growth in 10, 15, or 20 years. The caps kind of make sense. If you're working with clients in their mid-60s, you might want to consider using the 20-year cap. If you're pushing upper 60s, you might want to look at the 15-year cap. And if you're working with people that are in their, say, 70 or early 70s, they're still relatively young when it comes to long-term care. So why not give them some good growth, but cap it at a realistic level and put the premium in line where they could potentially afford it. And with the custom package, if you buy anything less than 5% compound, whether it be lifetime compounding or one of the cap growths at 10, 15, or 20 years, it comes with what they call a built-in buy-up feature. Every year on your policy anniversary, I'll give you an example. Say someone started off at 2% lifetime compound. Every year on the policy year anniversary, the policyholder can elect to make that number a bigger number. So say 5 years down the road, they feel like 2% is not enough. Maybe their income's gone up a little bit and they want to kind of boost up the value of their long-term care policy. They can make the request to the home office to increase that number to any number they want higher than 2%. It just can't exceed 5. So they can go from 2 to 3. A year later they can go back to 2. They can go up to 4. So every year they can make a move with no evidence of insurability. In other words, no additional underwriting. If they do increase the number, the incremental difference they're adding to their policy is added at their now attained age. This is not a forever offer. It goes away after the 20th policy anniversary or at age 75, whichever comes first. Yeah, I just got through explaining the guaranteed buy-up option. Again, unique to the mutual product. There's no other insurance, there's no other long-term care insurance product out there today that allows you to make this move to increase your inflation protection without any evidence of insurability. So it just should give you more peace of mind in positioning an inflation protection that might be a little bit low in your own opinion today, but knowing full well that it could grow in the future could put you at ease as far as knowing that your client could increase that number if need be in the future. And again, just to show you a couple of examples here, we just took $150,000 and showed the growth over time at 1, 2, and 3%. And you can see even at 1%, if you're working with a 50-year-old who buys 1%, I mean, that policy is going to be worth, you know, $223,000 potentially when they claim. That's not bad growth. I mean, inflation protection has not been on long-term care insurance policies all that long. It's only been in, say, about the last 15 or 20 years that CNA all of a sudden developed this marketing idea, hey, I think these policies need to have inflation. Otherwise, prior to that, you bought a policy that would pay $150 a day for 3 years, and that's exactly what that policy would pay when you went on claim 30 years later. So it was a marketing idea that got the whole inflation protection going. It was ingrained in our brain that you had to buy 5%. That thinking has changed now where 3% makes more logic. Even John Hancock pushed the CPI concept for quite a while. And now our thinking is, you know, regardless of the percentage you buy, if you buy something, you're in the game and you can increase it over time, and you can feel confident your clients can do that as well. So what I'm going to do now, if you just give me a second here, I'm going to pop out into the software. And before I leave, I'll go back to that Word document I had on the screen, which it has the download information for how you download this quote software. It should look very familiar to you because it looks exactly like the Assured Solutions Gold quote software is. And what I'm going to do now, I'm going to start muting some phones. And if you have me on a speakerphone, if you could please hit your individual mute button or dial *6 once I unmute you. And I'd like to make this part of the presentation as interactive as possible. So if you have me on a speakerphone, please take me off a speakerphone. If you have me, and if all possible, mute your individual phone by dialing *6. Because as I go through the software, I like to have anybody and everybody just kind of jump up with any questions they may have and just present them to either myself or Don. So again, the same input screen where you input client information, the information about yourself, and you can hit this box right here where you can, if you check that box, it will always have your name in the agent box. Okay, someone has me on a speakerphone. Whoever has me on a speakerphone, would they please take me off? That would be great. Okay, so obviously you select the state, Hawaii. The partner status hasn't changed from the gold. It's partner 1 insured, partner 2 insured. The two insured discount still is at 30%. The partner one insured discount is 15%. And again, this is for both married couples and domestic partners. On the application, you'll see that if they are male-male, male-female, female-female, they just have to be living in a committed financial relationship for at least 3 years. The biggest difference you'll see is now we have gender distinct. So you need to make sure that when you're quoting a single person or a married one insured person that you have the right gender selected, whether they be female or male. The software will default when you first open it to be a couple, with the male being listed first, and usually it's set to both of them being 60 years old at a select rate class. So just be very careful if you come in to quote a single female that you change the gender to the appropriate gender, because it does have a significant impact on the premium itself. Again, you can select the age from a grid, or you can type in an actual birthday, and if you do type in a birthday, and if that birthday is within 30 days of the day you're actually running the quote, the software will automatically save the age at the age last birthday, because the company does have that policy in place where they will go back automatically 30 days from the day of an application to save age. Again, the software defaults to select or standard. If your clients are approved for preferred, they will automatically get it during the underwriting process. That's an additional 15% discount. Couple of rules here to know, understand from an underwriting perspective. If your client is under age 65 and they're going for a preferred rate, they will not get it unless they've had a physical with complete blood work done in the last 2 years. If you have somebody go through underwriting and they're under 65 and they're offered select, and the only reason why they're being offered select versus preferred is because they haven't had that physical, they have a 60-day window from that date to get a physical done in blood work and get those results back into the underwriter, and they will consider issuing them with a preferred rate class. So I wouldn't recommend, so if you're working with a younger person, they look pretty healthy to you, and they haven't had a physical within the last 2 years, I would say don't recommend they get one before the underwriting process. Let them go through the underwriting process, and if they're going to be offered preferred, if they get a physical with blood work, then encourage them to go have a physical with blood work with the with the hopes that they can get re-rated to preferred. It would just save a little bit of time and expense in the front end to have that be a back-end type of an operation. If you are working with clients that are 65 years old or older, and they have not had a physical in the last 2 years, they cannot even apply for coverage. That's the very first health question on the application. It basically states, are you 65 years or older and have had a physical within the last 2 years with complete blood work? And it's a yes/no answer. And if it's answered no, then it's an automatic knockout. Your monthly benefits are here, the minimum being $1,500 a month, the max being $10,000 a month. The max plan length you can get on the custom is a little over 8 years, whereas the minimum plan length you can get is 2 years. So the software will only allow you to compute what is legal based upon what you're working on as far as a quote for someone. Pools of money, as I mentioned earlier, are $50,000 to $500,000. We've developed a neat little tool in the software. It's called Pick Max. If you were to hit that bright green button, it brings up a grid. And anywhere you just click on the blue box and drag this mouse anywhere inside the grid, it is a legal configuration within this grid. It tells you here exactly what you're doing here. I'm on a policy limit of $110,000, which is showing here. I have a monthly cash benefit of $1,560, which is showing up on the top grid. A monthly benefit of $3,900, which is showing across the bottom grid. It tells you how long it will pay out the cash. It will tell you how long it will pay out for traditional reimbursement with the premiums for the 2 clients you're working on. So again, as you drag this mouse around, it's a dynamic tool for figuring out where you might want to land as far as a benefit package. Just another way to make it easier for you to select where you might want to go. Elimination periods are all here, anywhere from a 0-day to 1 year. The rider to add 0-day for home health coverage is right below it, just like it was in the Gold software. The inflation terms, lifetime, this is the cap of 20, 15, or 10 years. And then we put the inflation rider on a slide bar because there are so many to select from. When you first open the software, it defaults to 3%, but you can drag the bar down. And once you have it set for one of the people, you can drag the bar individually for the spouse, because spouses do not need to buy identical benefits unless they're going to buy shared care as a rider. PIC inflation is not really applicable to you in Hawaii because Hawaii has not implemented partnership yet. But if you do business elsewhere, that could be an invaluable tool to tell you what the partnership rules are for that state you're trying to run an illustration for. The software, when you first open it as well, will have the assisted living and the home health care benefit be equal to whatever you select for the nursing home benefit. You can reduce these to be less than, but I would caution you not to, especially in the home health care. If you do reduce the monthly home health care benefit, it has a direct impact on the value of the cash benefit, because the cash benefit is tied directly to 40% of whatever you have selected for a monthly home health care benefit. If you're working with a married couple or domestic partners, you have the same shared care rider that was on the Assured Solutions Gold, the same survivorship rider, the same joint waiver of premium, and that unique spouse security benefit if you're working with a couple where one of them is clearly uninsurable. You can add a pretty inexpensive rider called professional home health care. You have your base home health care benefit, which will cover all levels of services in the home, whether it be a home health aide or a therapist or a nurse coming into your home. But if you feel like that's just not quite enough, you can bump it up where on those days that you do have a licensed therapist or a nurse coming into your home, your daily benefit for that day will double for all your expenses that day. It is a pretty inexpensive rider to add because there is a cap to that benefit of 365 days over the life of the policy. Once in a while we get asked about return of premium. With the custom package, there are 3 different flavors. There's the full-blown return of all premiums paid in minus any claims paid out, death at any age. Pretty expensive rider. In fact, very expensive rider. We have a unique one here called 3 times the MMB. What that means is if you buy that rider and you pass away, the company will return 3 times whatever your initial monthly maximum benefit is. So the example here would return $9,000 minus any claims paid out to your named beneficiary or to your state. So that option, albeit being very inexpensive to add, it can be viewed as a small little burial plan that you could add to the long-term care policy. And then if you have clients under the, at a younger age where they raise the objection, what if I die and never use this thing? There's a return of premium if death occurs prior to age 65. With all these riders, you have to be 64 years old or younger to buy any return of premium. Additional discounts that can be had with the mutual product if you have set up an association approved by Mutual of Omaha. Those association members and their spouses are entitled to an additional 5% discount. The producer discount is there for your taking. If you were to write yourself and or your spouse, you are eligible for an additional 5% discount. Some of you may remember that back in the day, United of Omaha was in the group long-term care business, what they call multi-life. They're no longer in it. They've been out since 2012, and they're not back in it either. They have a special program set up where it's called a common employer program. If you're working with a company and at least 5 employees of that company express interest in applying for long-term care at the same time, they will be entitled to an additional 5% discount. There's no list bill involved. They're all direct bill. The employer cannot be involved as far as payroll deduct and such because these are gender distinct rates. And it goes back to the Civil Rights Law Act of 1965 that specifies that all insurance products offered in the worksite have to be unisex rated, and these are not. So again, it's a program you can take advantage of, very unique, one-off, and if you have any potential interest, contact either Don or myself, and we can help you walk through it. So that's the new product. I'll briefly touch on Secure. just to give you a feel for what Secure does, you'll see that it's a traditional way of building a 2, 3, 4, or 5-year plan. The monthly benefits are all the same across both products, the minimum being $1,500 a month up to $10,000 a month. The elimination periods are a little bit less, a little more restrictive. You can't get less than a 90-day elim. The waiver is still there. The inflation protection options are limited to 3, 4, or 5 on the whole number only, and then 3 and 5 capped at 20 years. No buy-up, no guaranteed buy-up. So if you buy the Secure with 3%, you've got 3%. You're locked in. The cash benefit again is at 30%. If you're to build a Secure and a custom as close as you can, apples to apples, there's about a 2% difference on the price, with the custom being about 2% more. We fully feel it's worth it for those additional 2% to get access to that flexibility of the plan design with inflation protection and obviously the 10% richer cash benefit. So that kind of wraps up my part of it. The phone lines are open. Do any of you out there have any questions about the new product that I could potentially ask for you or answer for you? John, you posed a question about the household discount. The household discount has gone away on the MutualCare Solutions portfolio, where it was there with the gold. So you can no longer do like a mother-daughter or father-son on the new product. Does anybody else have any questions? Hey, Don, you want to pipe up and say hi to everybody out there? You've been talking to them pretty consistently for the last month.
Hey, how's it going, everybody? We're glad to have you on the webinar. Glad everybody's here. And if you need anything, again, I'm here always. Dave Whalen will help me through some stuff if I have any questions, but I'm here for everybody to answer any questions and help you any way I can.
Dave, thanks, Donnie. Do appreciate that. One more chance for questions. Okay, as I mentioned, we did record this session, so it will be available as early as this afternoon later on to view on our website if you want to go back and review it. We're easily accessible at the number you're seeing the screen at 672-7202. I've got the link here on how to download the software. At the yaim.com/software, you'll be downloading MutualCare Solutions software. Again, it's a pretty nice and easy look and feel. If you're used to using the gold software, you'll love the new software as well. We have hard copy applications here. We have them in a fillable PDF as well. If you need supplies, either call and ask for myself or Donnie, or you can pop Don an email address or email request at don.erickson@yaim.com.
I have a question. Can you hear me?
I can.
Oh, great. Are we in the last state to get approved for your new product?
No. Montana and New York are still hanging there with the old one.
Okay. And I was wondering, that 90-day elimination period, is that offset for as many days of home and community care that they
It's a pure calendar day elimination period. So if your claim starts off at home, the clock starts when you have your first day of service from an agency at home. In 90 calendar days later, your elimination period is satisfied. The rule with Mutual is that you have to have at least 8 days of service during the course of any month for all 30 days to count.
Say that again, I'm sorry.
You have to have at least 8 days of service during a calendar month to have all 30 days count towards satisfying your elimination period.
Okay, great. And that extends into facility care as well, that you satisfy that 90 days. There's no additional 90 days that's required, right?
There's only one elimination period for the entire policy.
Okay, great.
Yep.
All right, thank you.
You're welcome. Good question. Any other questions? Okay, if we didn't address your question, or if you have additional questions that come up as a result of listening to us today, feel free to reach out to us either via email or a quick phone call, and we'd be happy to continue the discussion. Like I said, if you need supplies, call or email us. I want to thank you again for taking the time to join us. Thank you for listening to Donnie's voice over the last month. I'm sure he will be staying in close contact with each and every one of you. Thank you all, and have a great day.
Thank you.
Thanks, everyone.